Okay, welcome back to Inventory Watch for the Phoenix Metro for the week of October 21st. Last week, we talked about the trends that we were seeing in the rental market with a lot of decreases coming to the market. And I did a little bit more research and did a little bit of a bigger deep dive. And so I want to go over that a little bit more. But before we do, let's talk about what's happening in the home buying and selling market as far as inventory is concerned. And let's take a look at what's going on. I'm going to stick this in presentation mode and reduce my little face here. All right, let's get into the numbers and see what's happening here in the Phoenix Metro as far as housing inventory. The active and contingent inventory is up 3% again from last week. And the week before that was another 3%. So we are still going up in inventory. And you can see there was kind of a big increase this week compared to where we were week 3 September. Week 3 September from the prior month was only a 1.8% increase, but this week we saw 11% increase in inventory. And I think you'll notice again from the next slide that we go into with the new listings that it's not all from new listings. It's still from inventory kind of sitting on the market a little bit longer. We did see a slight increase in average list price coming through at $795K. But when you look at the average sale price, we're still selling in the average of like $550K, somewhere around there. So, and of course, this data is courtesy of the Arizona Regional MLS, and I am a member there. So thank you for the data. So let's go look at new listings. And what we can see this week is there was a very slight increase here in brand new listings coming to the market. So I think this is the first time we've seen this in a while where we actually saw a little bit more fresh inventory come to the market, so if you are looking for a home, there is some fresh inventory out there for you. And but it's still not quite enough to what we need here for the Phoenix Metro. I think as a whole, like inventory is still really, really low. And to put that into comparison, where we have that active inventory, like the total inventory was about 17,000 with active and contingent, and we need like 30 to 45,000, somewhere around there, to kind of have more of a healthy market. So we're still really, really low in inventory. But the reason why inventory is growing is because buyer demand is also low. So when we have that balance of like, we have super low inventory, we have super low buyer demand, the market's kind of at a stalemate right now. One of them's going to give, either interest rates are going to come down and buyers are going to come back to the market, or we're going to see more listings and demand kind of like being weird and staying low. And like either way, the market's going to shift one way or another. It's unusual for buyers and sellers to be at the same level. And the level is like the lowest ever in history, I feel like, for both of these buyers and sellers. Maybe not history, but they're both pretty low. So that's new listings, just a slight tick. And let's go into sold inventory. So what we're seeing in sold inventory this week is that we're down for the month over month comparison, we're down 8.4% in buyers that have exited the market compared to last month. The average sold price, $555 in September and $575 in October. So we did see the average sold price kind of go up. We did have a $10 million listing, I think, close this month, which is unusual for a market. And since we have such low inventory, that listing is really going to affect the average sold price. And so I'm not sure 100% because I haven't taken a deeper look at the average sold price, but I have a feeling that that listing raised the average sold price. I don't think that regular Joe buyers are out here increasing the market. I think the luxury market played an impact in this number. Let's look at pendings, because like I always say, pendings tell the future of like where we're going in the next 4 to 6 weeks. And what we're seeing in pendings is another decrease in buyers in the current market. So the solds were buyers from like 4 to 6 weeks ago, and the pendings are now buyers. And these are buyers running around the market right now, looking at houses and making offers. And so what we see here is now buyers are down, another 30, 40 buyers again this week. And so every week I come and I say like, oh, now buyers are gone, another 30, 40. So we are seeing that still continuing to trend down, the active buyers in our market. Again, this one, we are seeing the active pending, or the average pending price at 586, which is up from week 3 in September. So if we're comparing week over week, or the same week in September versus October, we are seeing the average pending price go up. Again, I haven't done a deep dive to see if this is a result of the luxury market or not, or if this is actually real buyers like putting offers in on higher price houses. So, but I think if we look at like week 1 October, week 2 October, week 3 October, it's going to average probably somewhere closer to that 540K mark. Because last week, the average pendings, I think, were at 524. And so the delta between 520 and 580, like it's going to bring that average down by the time we get to the week 4, which is next week in October. So let's look through pendings. So this is the trend. So this is the same number of active buyers this week, and the average pending price of 584. But you can see since August 5th, you can see the number of buyers in our market has just continued to wane down. And we did kind of like bottom out here. So we've been like at this low, like this is like kind of the bottom, like this is the average number of buyers that can kind of afford this market right now, is about 500 to 600 buyers per week in our market. So it's kind of been flat here, some like a little bit rise here at the end of September, but we always see that at the end of the month with rate locks and things like that, like the buyers like ending out, like putting something under contract so that they don't get into higher rates. So something to consider, that like maybe we've kind of hit the lowest of the low, since we've been, since September 9th, kind of at this level. If we see another big increase in interest rates, we will see this trend probably tick down again, because some of these buyers will now not be able to afford the market. So we'll see how much higher the rates get over 8%. If they continue to rise, then expect this number to drop again in the future. But if we're kind of holding at 8%, I kind of think like this is the left of the buyer pool that can afford this market. So it's kind of where we're at right now with pendings. Let's go back and to look at the rental market. So that was the homes for sale and homes to buy market. Again, buyer demand really low, sellers are really, really low. Again, I keep saying this. I feel like this is my favorite post. But, one of them is going to give, and the market's going to shift in one way or another. And what I think will affect that is this market right here, the rental market. So let's talk about what we're seeing in this rental market, because it's been really, really interesting. And I've done a little bit more research about it this week that I want to talk to you guys about. So this is new listings in the rental market. So not total inventory, but new listings coming to the market actually is down month over month. So we saw the same thing in the rental market of like total inventory increasing month over month and week over week, because rental demand was also down. Like affordability just put a stop in this market, and people finally just said like, no, I can't afford that. I'm not getting a $2,500 rental. Like I just can't afford it. And so people were boycotting, like they're boycotting the market, like, because they can't afford it. And so we saw rentals start to stack, not because we had all this brand new inventory, but again, because it just was piling up because nobody was renting. Demand was down. So same thing we saw this week is that rental inventory, new listings is actually down 6.7%. But active listings, total listings is flat week over week. So just because new listings was down didn't mean like inventory went down 6.7%. It actually stayed around the same. which means that we didn't have enough buyer demand in the market to pull that number down and to create like a frenzied market. So the rental market is still kind of slow. As we can see here in pendings, active renters this week was 233. So again, the same thing from August 5th, we had like this peak of like renter demand from when I started tracking this. So we had a higher number August 5th. And again, every week after that, like renter demand just plummeted and we kind of bounced up. And I think like this is kind of our average between like, 150 and 250 renters per week, putting stuff like, putting new leases under contract. So not quite as many as buyers right now. Like there's still more buyers running around the market than there are renters. But I think this number will change over time, like going in, if the rental rates continue to decrease at the rate that we have been seeing them, we're going to see this rental demand start to pick up, because what's going to happen is that buyers in the market will start seeing rental inventory like, oh, I can rent that house for $1,700 a month and it's 2,500 square feet and 4 bedrooms, versus like, oh, buying a house 2,700 square feet, 4 bedrooms, it's going to cost me $3,500 a month. But like you could cut your payment in half if you just rent it. So if we continue to see this trend, we are going to see like it's going to cause a little bit of damage to the buyer market that we have now. So keep this, so make a mental note that like right now we have 500 to 600 buyers every single week in the for sale and market, and we have about 200 to 250 in the rental market. So once we see the buyer market start, like if those numbers continue to come down and the buyer market might be bottoming out here, and we might start seeing more renters come to the market as prices decrease. And so that's the one thing I'm going to keep my eye on for the future, because I think that's really going to impact the buyer and seller market. So we saw another decrease in pending price in rents come down again, about another 1%. Last week we were at 2120 for pending rents, and this week we're at 2095. So let's talk about price reductions by large institutional owners. The one thing that I want to make clear, what's different about our market here in Phoenix versus some other markets, maybe on the East Coast or the Midwest, is that we have a very large number of institutional owners of single family homes in our market. And when you hear the rhetoric in the national media of like, oh, they only own 1% of the housing market, it's not bad. I kind of don't like that rhetoric, because they may only own whatever small percentage that they say in the media, but the amount that they own in certain markets is enough to control the market. So we're talking about these big investors that own thousands of homes in concentrated areas, which gives them market control. So when these investors say, oh, affordability is too high, our properties are sitting vacant, we're just going to start slashing prices. And when they do that, it affects the market as a whole, and it creates this kind of systemic price reduction frenzy. And so that means regular investors who want a stable market have to go along with what the big players are doing. And so let's kind of take a look. I want to take a look at a couple things. I did some research on who the big players in our market are. I have this spreadsheet here called Institutional Holdings, which I will make bigger for you guys. So these are the bigger players in our market of who owns inventory, right? I'm going to ignore Open Door right now because they have a different model, but we have no data in that one. But for example, we have Home Partners, And this is total properties owned. Not all of these properties are in our market, but this is their total portfolio, like across the country. And again, these properties are concentrated in certain markets. And one of them is ours here in Phoenix. Atlanta is another big one. I think some parts of Texas and Florida, and possibly like Denver, Colorado, and things like that. So they own a lot of properties kind of in certain markets. And so, for example, we have Home Partners. They own 23,000 homes. Invitation Homes has a couple of different ones here, but in total, they own 77,000 homes here. And you can see their portfolio numbers, like this is their portfolio value, right? And so there's all of these like huge holding companies that own properties. And this one is in red because to me, when I look at the numbers for Tricon, who is also in our market that hold a lot of homes, Tricon has this one here, 16,000, and I believe this one here is almost 8,000. So they own almost 24,000 homes across the country, and many of them are here in Phoenix. And I highlighted this one in red because when we look at the amount that their portfolio is worth, $4.5 billion here, plus another $2 billion up here, right? But this one's separate. I only highlighted this one down here. They have two separate portfolios, and this data is from PropWire. So if this, I haven't 100% validated this data, but if this data is close to being correct, they have a $4.5 billion portfolio across the country with 16,000 homes. However, their mortgage debt is in the trillion. It's 4.3 trillion. This is trillions. And so when we look at their debt to equity ratio, right? And so they have 4.5 billion in a portfolio value, but their equity after their costs and everything is only 1.4 billion. And compare that to the 4.3 trillion dollars that they have in mortgage debt. That makes their debt ratio so high. Like this is the average, right? Like the highest is Invitation Homes with 1350. And then the lowest is, this is a home builder, not necessarily a single family renter. So this is a home builder who has a 3 debt ratio, which is like a normal one. But when you're talking leveraged debt coming from institutional holders, like 500 to 1,000 seems to be like a normal amount. Well, Tricon, this portfolio is 2921, and it's like almost 300 times larger. Like the debt ratio is larger than the average in here. And so to me, that is a huge red flag that Tricon may be over leveraged here. And they own a lot in our market. And one of the ones I wanted to show you was recently, they had this house. Maybe it's this one over here. They have this house for rent in Mesa for $24.29. And when I looked in the tax records for this home in Mesa, it's brand new. And they even say it like, receive $500 off first month's full rent, valid from 10/5 to 10/31, right? So you even get $500 off your first month's rent. Parkside Villas is a gated community, blah, blah, blah. When I looked, enjoy this never before newly lived in home. This is a brand new construction home that they purchased straight from the builder and put it straight on the rental market. And when I look at the price history of this, they started at an asking price of $27.29. So they've cut the rent to this one by $300. Plus, they're giving a $500 move-in incentive if you want to live here. What's concerning about this one is that this home in Mesa is 4 bedrooms, 2.5 bathrooms, 2,000 square feet, right? It is the purchase price on this home that they got it from the builder for was about $549,000, which to me is just like, it's just mind-boggling on the fact that we're willing to go into that much mortgage debt And I don't know how much they financed on this property, to be honest with you, but they did purchase it for $549,000, and they're now dropping the rent on this home at such a large level. So, and I don't know if they've got this under contract yet, but it is concerning to me that is what I'm seeing with Tricon, that they just are buying these houses, are so inflated, and they're trying to rent them, and now rents are coming down. And so being so over leveraged like that we saw in their numbers, is they're going to be affected first as rents plummet, because they have a debt service that they have to pay. And if the rents that they're collecting doesn't cover that rent service, then they're going to start listing these homes on the market. So that is something to watch for this one specifically. Here and there, I'm a little concerned. And so when we come back to after, looking at that list and understanding that there is a debt service, that these people are not paying straight cash for these properties, like we think that, oh, they come in with all this cash, they're cash buyers. Well, guess what? It's still leveraged. And that's what we're seeing. And when we come back here, and we see these price reductions, again, we have all those institutional investors in our market. Invitation Homes, like Tricon Homes, Cerebus was another one on there. We could go back to the list, but all those companies have homes here in Phoenix, and tons and tons and tons of homes. So that means that they can control our rental market, because they have so many rentals here. And if their rentals are sitting vacant, it's not emotional for them. They will just slash the prices, get more people in there. But what's going to happen is that, like, the smaller investors, like, you and I, who used to be the majority of the rental market here, where it was more stable when we didn't have these investors in the market, these institutional investors in the market, like, it's creating this instability, because they can just like buy as much as they want and then slash the prices. And remember, they came in 2008, 2007, 2009, and they were buying these properties at 70, 80,000. So for them to just come in and slash prices on some of these properties, like, it's nothing to them, because they bought a lot of them for a really great price. And so they have and now they can take advantage of the law of averages inside their portfolio, where they got some that they purchased at 700 or 70,000, and some that they purchased at 400,000. And when you average it out, like, as long as the average rent still works for their numbers, like, that's cool, right? But for the average person who maybe has one or two, and like, you're relying on a stable rental market, it could be costing some people to start to possibly want to sell. So I've got one more thing that I want to show you guys. Let's talk about sold rental inventory, which is sold means it's been leased. Huge reduction in leased properties from September to October. And so I'm thinking all of these price reductions that we're seeing is going to start stimulating the rental market again. I don't know how much more reductions we need to see in order for it to be fully stimulated, but I have a feeling that these institutional investors have no qualms in just continuing to drop these prices until it's stimulated enough, right? Some of the ones that even the institutional investors that I think are over leveraged may be hurting a little bit by this, but the other ones, I think they'll be okay, right? So what this could be doing to a market, what we're going to continue to see is, like, if we see continuing decrease in rental prices, which are creating much needed affordable rentals for us right now, will prolong the stagnated home buying market. As I said before, it's because that people who are thinking like, oh, I'm going to go buy, when they catch wind that they can rent something for like $1,700 now, like, instead of buying for $25,000-$3,000 mortgage payment, they're going to opt to save that money. And so it's going to bring the number of buyers out of the market. It's going to remove more buyers from our market. So seeing this decrease in rental prices is concerning. especially going into the 2024 buying season. So if we continue to see rents decrease and get slashed through the end of 2023, I think it's really going to affect our buying season in 2024. Investors that are over leveraged will look to sell off non-performing assets. Okay. So just like we talked about, I think that Tricon and like some of these other ones who are over leveraged, or they, even if they're not over leveraged, they're going to start selling non-performing assets and keep the ones that are performing. And so they're just going to come in and they can put it on their market and they can kind of cut the price. And again, that's going to the same thing, how cutting the price in the rental market is going to affect. I think that if enough of these institutional investors puts inventory on the market and they start cutting the prices because they have no qualms about it, that it will affect our housing market as well. So something to keep an eye on. I'm not seeing it yet that they're offloading all these properties, but it's something I will be looking for sure. And if that starts to happen and they start cutting the prices, it's going to start affecting regular homeowners like you and I who may need to sell to move for a job or, downsize or whatever those reasons are. So again, something to keep an eye on. And then that increase in inventory. So if these investors do start to offload some inventory, and we don't see an increase in demand from buyers because interest rates, if interest rates don't, it's all dependent on that. If interest rates don't come down in 2024 and we do truly stay higher for longer, we're going to start seeing the housing inventory, for sale inventory build up, and that will probably decrease our prices here if the demand falls even more. So that's what I got for you guys today. So if you're thinking about buying or selling a house, just make sure it's something like that you can afford. Again, for those of you who don't know, if you need to sell your house, like going into 2024, I have a tool called Sold Score, and you can, we're going to run out of battery juice. You can go to mysoldscore.com, and I'll just show you what it's about. mysoldscore.com will score your house and tell you how likely it is to sell in this current market. And so what you can do is come in here and click on Get Started and enter your address, and it's going to score your home for you and say like, oh, if your score is over 50, it's more likely to sell in this current market. If it's less than 50, then there's some work that you can do to help optimize your home to make it more saleable in this current market. So that's going to be things like, some fresh paint and curb appeal and all of the things that a realtor can help you do. But the Sold Score will help you understand where your house kind of sits. Every zip code is different in the Phoenix Metro. We have so many different micro markets here. And so this is a good way to get started if you're thinking about selling your house. So thank you guys for watching, and we will see you next week.